Hey everyone, welcome back to Corporate Decoder. In this video, we're diving into SEACOR Marine's latest 10K filing, their annual financial health checkup. You know, the kind of report that can lull you to sleep faster than a maritime law textbook. But trust me, we'll make this interesting. Unless you enjoy having a vessel run aground on the shores of boredom, let's get to it. First off, SEACOR Marine provides crucial support to offshore energy facilities all over the world, including wind farms. They're like the unsung heroes of the sea, delivering supplies, equipment, and personnel to keep these operations running smoothly. Looking at their fleet, as of the end of last year, they operated 54 vessels. Most of these, 51 to be exact, are owned outright, while a smaller number are managed for other companies. These aren't just any boats. They're specialized vessels, including platform supply vessels, or PSVs, that haul cargo to rigs, fast support vessels, FSVs that zoom personnel around, and lift boats, stable platforms for offshore work. It's worth noting that they're also investing in cleaner technology. Several of their vessels now use hybrid battery power systems, which improves fuel efficiency and reduces emissions. It's like trading your gas guzzler for a hybrid, but on the high seas. And SEACOR isn't sitting still. They've got 2 new PSVs under construction in China, expected to join the fleet in 2026 and 2027. This shows they're looking ahead and investing in the future. Like any business tied to weather and project schedules, SEACOR's demand tends to fluctuate. Things get busiest in the summer months, especially for their liftboat fleet in the US and their support vessels in Europe and Africa. So winter is often the time for maintenance and repairs. SEACOR has some big customers that make up a large percentage of their income. 2 customers alone, Azul Energy and SEACOR Marine Arabia, accounted for 40% of their revenue in 2024, a big dependency that can be risky. If they lost one or both of these customers, it would hurt business. Now, the offshore marine service industry is competitive, which means SEACOR fights with other companies for contracts. The most important aspects for clients are what you charge if you have the necessary equipment and increasingly how energy efficient your vessels are. Because they operate in the United States, SEACOR must comply with the Jones Act. This act requires that vessels used for coastwise trade transporting goods between U.S. ports be American-built, American-flagged, and mostly American-crewed. It's like a Buy American law for the seas. There's also a risk that, in a national emergency, the U.S. government could commandeer their ships. It's a little-known fact, but the government has the power to take control of these vessels if needed. Safety is paramount for SEACOR, and their safety record is very good. In 2024, working over 5.9 million man-hours, they recorded 0 pollution incidents and 1 medical incident. Now let's flip to the financials. The market value of the company's stock held by non-affiliates as of June of 2024 was around $325.9 million, a major thing for investors to note. They currently don't pay dividends and are instead reinvesting into the company. A big challenge for the company continues to be fluctuating oil and gas prices, which drives demand for their services. Cybersecurity is also a big one for all companies. These guys recognize that. And like any responsible company, SEACOR publishes a sustainability report, detailing their efforts on the environmental, social, and governance front. This includes things like reducing emissions and ensuring diversity in the workplace. Of course, with every business, you need to consider the risks. One major risk is low demand for oil and natural gas, which directly impacts their operations. Their debt is also something to keep an eye on, with $350 million outstanding as of the end of 2024. Debt is fine, but you need to make sure that you can service it and that it doesn't stop you from investing. Also, compliance with complex and ever-changing regulations adds a lot to costs. A lot. There's also the Jones Act, which limits the amount of stock that can be owned by non-US citizens, which can be a double-edged sword since it creates advantages to the company but might make them miss out on some possible investors. Finally, the management has confirmed that internal controls on its financials are effective, which is essential for investor confidence. And external auditors are on the same page as management, confirming that everything is accounted for as is should. Lastly, several of SEACOR's directors and officers adopted Rule 10b 5-to-1 trading plans during the fourth quarter of 2024. These are prearranged trading plans that allow insiders to buy or sell company stock at predetermined times and prices, helping them avoid accusations of insider trading. So what's the takeaway here? SEACOR Marine is a key player in the offshore energy support sector, navigating a complex and ever-changing environment. They're adapting to cleaner technologies and evolving market demands, but they face significant risks from fluctuating commodity prices, heavy regulations, and reliance on major customers. SEACOR seems to be focusing on the right things. They're investing in newer, more efficient vessels, they're doing a lot to minimize emissions, and safety continues to be a priority. The numbers, as they are, might seem a little scary. The company has a history of losses, which has historically been a worrying sign for investors, but they seem to be getting it under control since those losses have been shrinking in the past couple of years. This could be something interesting, as long as oil and gas prices remain relatively stable and SEACOR can manage their debt and continue to innovate. They are reliant on two major clients for revenue, which I don't like much. Thanks for tuning in to Corporate Decoder. If you found this breakdown helpful, don't forget to like, comment, and subscribe for more insightful dives into the corporate world.